venture, I mean, it continues to be a popularity contest. And like some of them you look back in hindsight, and I remember one in particular, I can't remember the name of the company, but it was the quickest raise we ever did. It was on a Saturday, right before brunch. We put the deal up. I got in the shower, got back out, and we had raised $450,000 in about 9 minutes. And we ended up getting cut back to like 100K on that, which was a bummer. But then the company 12 months later ran out of cash and went out of business. So it's just like, I mean, I mean, well, obviously we still lost our initial investment there and it was a bummer, but it was like the times were just really weird back in 2021. We all kind of in one way or another have witnessed that and been part of it. Hopefully just not too many of them.
Yeah. You're listening to the Sandhill Markets Podcast. I'm your host and Sandhill Markets CEO, Adam Hardy. Here at Sandhill, we focus on providing education, community, and access to venture. With this podcast, you'll get a seat at the table for discussions with other founders, investors, and innovators. I'm excited to learn a lot from these discussions, and I hope you are too. I'd love to get like a more general kind of background and all that stuff, but just because it's an easy segue. So you're at the Series D, you're in the operating spot or in the operating position. You start syndicating these deals, and you become Chaos Ventures is, I think one of the most active, or at one point was one of the most active syndicates on AngelList. And then kind of, was it always the plan to move on to the committed capital structure and to raise a fund and deploy and to stop syndicating and to continue to invest out of a fund? Was that kind of always the plan, or did it kind of naturally happen?
It was kind of the plan, but then also naturally happened. I mean, my entire career up until taking the operator role was on the investing side, or sell side and buy side. I'd worked in leveraged finance for Jefferies years ago, and then worked in private equity, private credit, and then started doing venture capital investments back in 2013, actually through my soccer team. I play a lot of soccer in the city on a bunch of co-ed teams, and the first one I happened to join was a bunch of random people that all happened to be early employees at Uber and Slack that, had these cool deals. So we just started doing angel stuff together, and that's how I got.
Yeah. You're like the banker you're the banker on the soccer team that like knows how to do it.
Yeah. Well, at the time I thought, I got a great job. Turns out they actually had the better jobs. Fast forward 10 years, but no, it was a great experience, like getting to do that kind of stuff. And then I segued that into actually doing more professional venture investing. And I worked for Bradley Tusk when I first came over from Providence, and worked out of their first fund, which was really interesting work on investing in kind of consumer seed and Series A companies that were heavily regulated. Went and worked for an insurance carrier out of their corporate venture group. And then right after that started the dual role of basically operator and Chaos Ventures at the same time. The operator role was really to kind of also get a different background on operationally than I had previously, because I come from a CPA background. So a lot of people will like take CPAs and kind of dump you in a bucket of like, potentially boring person with a lot of social anxiety. At this point in my career, I'm really glad that I have that background. I think it gives me kind of a into companies, but I also have always like been big on go-to-market strategies and sales, and so I ended up running part of the sales team over at a company called Rocked, which was a tigerback company that operated a piece of tech in the e-commerce flow, basically an advertising agency that was underlyingly run by machine learning. It was an awesome position that kind of like allowed me to really understand the communication channels between engineering, product, and go-to-market. And what I was doing though at the same time was doing a lot of syndication for deals, so long as those deals didn't compete with Rocked, which was not hard.
Pretty specific. It sounds like
yeah, for sure. I mean, so out of Chaos, I mean, we were doing a little bit of late stage stuff. My partner was, but like most of the stuff we like to do was seed stage and relevant to either fintech or healthcare. But what I realized, like really early on with, especially the network that AngelList had built out, and AngelList definitely built the best platform, and probably still the best platform that exists today because of the network of LPs they've built out. But as you do a lot of deals through AngelList, and we've done, at one point we were one of the most active syndicates. I think we did about $65 million in deals and 125 different transactions. But certain investors start to show up as kind of the same ones that are starting to back your deals. And those are the ones that you really want to build long-term relationships with. So, I flew out to Asia, flew over to the GCC, flew to South Africa, and started to meet a few of these people that were investing with me. And that became kind of like the base investments for what is Recharge now. And so I ultimately left Rocked, took that capitalization to create, Recharge's first fund, which is a completely different approach than Chaos. Chaos was definitely more generalist and trying to do, just get in with as many good founders as possible because it starts to create a flywheel, obviously, for both deal sourcing and diligence and everything else. But Recharge is really kind of like the dream of what I always wanted to build. And what my partner Lauren wanted to build too is a different approach to asset management in general, holistically, but also to venture that would be more efficient with venture dollars. And so the way we see it is like, Lauren and I have done a ton of angel investing together over the last decade. We can invest in amazingly smart people out of HPS, Chicago, MIT, Stanford, you name it. And they can have amazing ideas. It's the best job in the world because you get to see like the coolest ideas and like basically what the future is going to be. But time and time again, the biggest issue I see with companies running out of cash essentially is that they don't have good distribution at the beginning. So you just waste a ton of money trying to figure out, like on the enterprise side, who your pilot customers are, which ones to spend time with, which ones to do particular customizations, which one not. And then on the consumer side, it's just a game of ever increasing CAC. I think when we first came out with all these direct-to-consumer concepts, there was this idea that if you got better and better and better and more efficient at advertising, your CAC starts to creep up because customers that you start to bring on are actually more difficult customers to reach, hence why they didn't become customers when you first became a business. And so in order to make the business model work, you actually have to find ways to increase LTV over time. And so it really became about distribution. So my thought was, well, if we could create like a competitive advantage and moat across a venture platform that gave built-in distribution to seed stage companies, we could effectively like help them iterate on product at the outset, as well as kind of like extend the length of that low CAC so that they could figure out ways to add LTV to their business and basically give companies a better chance at getting that first set of revenue, getting to Series A, and then going on from there. Obviously, it's no guarantee to create unicorns, but I think it gives a better probability of basically accelerating value creation within the venture process. And so that's kind of like the core value here at Recharge.
Can you go a little deeper on what you mean by that? So it makes a ton of sense. I mean, I actually haven't heard it articulated that way, where it's not that you'll always keep CAC down, right? Like, or like some magic, like, CAC's always zero, right? Like CAC in most storylines, as you scale, like CAC is going to, maybe it starts low, but goes up as you mature and grow or whatever. Yep. And the LTV and building LTV, that makes sense to me. But this idea of using a platform, and that's what I want to kind of double click on, is using a platform at seed to extend that kind of Goldilocks period of low CAC while you figure out how to really solve the longer term LTV problem. Correct? And
that's right.
So just tell me a little bit more about, like, what does that look like in practice?
Yeah, no, I mean, I'll give a few examples of it. I mean, we've gotten to varying levels of success over the 4 years that we've been doing this now. I mean, it started out with, we have a portfolio of venture companies, some of which have made it, some of which haven't, but a few in particular have gone on to be unicorns and more mature businesses that have also reached this threshold of wanting to create both incremental revenue opportunities and layer in other technology enablers to their workflows to create efficiencies. And many times a company that's sitting at like a Series B, Series C stage, they're not a giant corporate that can hire a huge engineering team to go out and build these other ancillary parts of the business. And so in effect, we can use venture funds to help build technology that has distribution into these businesses. So we call those businesses anchor assets because they're not businesses that we necessarily majority control, but we have had a relationship with them since their inception. And we know intimately what their needs are to build out other lines of business. I'll give one example of that. We have a company in the mortgage service space, particularly a software layer that sits at mortgage servicers that allows them to interact with consumers and collect payments on mortgages. Well, the mortgage servicing business has been archaic for a long time. It has a very thin P&L. There's a ton of opportunity to go in and not just automate the labor workflows, but to also upsell end consumers with other products, because you have a multi-year direct relationship with U.S. homeowners. Why not sell them something else? You have data on their family size, the amount that they're paying on their mortgages, the age, the demographic, the particular location in the country on where their home is. And so we helped put together a company called M-Card that's very similar to Bilt. So instead of using your credit card to pay for rent and earn points on that and build credit, you can actually use your credit card to pay your mortgage. And the idea would be that we can basically use our existing portfolio company as a platform because they currently service several 100,000 U.S. homeowners, and layer into their UX or their email or however they're interacting directly with the consumer an upsell for this credit card. So if you can even get anywhere between like 3 and 5% conversion within a few months when you launch this product, you very quickly have a seed/Series A company overnight. And so that's the idea in that. I mean, some other examples would be that's a little bit different because that's an anchor asset. But what we also do is we create business platforms. So we'll incubate them ourselves. And one example of that is we created a Cayman holding company that has a very flexible mandate. We acquire fertility clinics mostly in Asia, and we see those as amazing distribution points into women's health in general. Not only that, but IVF is quite a trending service right now within general healthcare, and we only see it's going to get bigger. Four-wall economics on the businesses are amazing. They cash flow like crazy. There's virtually infinite demand, and there is a dearth of supply right now. We operate mostly in Asia because of it has less cultural constraints than here in the U.S., as well as regulatory constraints. But the plan is to build up a global ecosystem of fertility clinics, then ultimately invest in both technology and services through our venture businesses that can gain distribution through this network of clinics. So those are examples where we're actually kind of like mixing different asset classes, whether it's private equity, if you're looking at it as like a roll-up strategy, and venture capital to accelerate that value creation for those venture companies. And then we use some of our dollars to try and figure out the next anchor asset, if you will. And those are a lot of times based on like why now moments on very large macro trends. Whether it has to do with something within blockchain or something within pet care, vet clinics. We've been looking into that space. So those are areas that we don't necessarily have any positions in yet, and we don't have a platform, but we'd like to build out a platform so that we can also build tech on top of that. And so that's how we're structuring ourselves at Recharge.
Super, super interesting. I've never heard anything like it, and it's awesome. And I want to regurgitate to make sure that I'm kind of understanding. But so you'll run and I'm seeing your CPA, your finance guy background shining through with the roll up. They're putting together these these more classic, I guess kind of financing. I would assume of like those types of roll up strategies. But so you take like that's a more traditional like private equity like roll up approach, and then once you have that, like that builds your distribution platform, and then you'll seed invest into a company that would serve that well, and then and you control that platform, so you automatically like they skip almost as like you can run the numbers because it's your business or it's something that you're very, very close to, of like this will plug into what would be the equivalent of like a really big like flagship contract for a seed stage B2B company, but you like manufacture it kind of.
That's right. I would say a good way to look at it from the flip side is like on the venture side with our venture team. You look at a lot of venture funds that will do their proactive sourcing through making market maps. So you can take like healthcare, for instance, and split it up into 14 different areas and say, we're going to focus on these 7, and then we're going to figure out the 100 logos that are all building in that spot. And those market maps generally get maintained like every quarter or whatever, depending on the manpower that you have. Yeah. What we do is we look at it from a core workflow map. So, we'll build out a workflow map, call it like the patient journey through IVF and various ancillary services around IVF. And what we're trying to identify within that core workflow is technological inefficiencies. That's one area we can invest, or particular services that are basically being underserved to the patients that we could also invest in. And so that allows me to guide where my dollars are going. And you're correct in saying that when I make an investment, pretty, like I would say 99% of the time, I'm making that investment because I know I have a customer on the other end with one of my other businesses. And so I can drive revenue in that way. And so that's a real value add. But it also attracts entrepreneurs building in the business because I'm not set up as a venture studio. So I'm not necessarily incubating these businesses all the time. We can have a team that's already been building, maybe a few million in ARR, but they're really looking for, that one big customer. And we can help them get that if they fit really nicely into these kind of workflow maps that we're building out. As it stands, to answer your other question, kind of on like the private equity side of the business, I don't really refer to it as private equity because that implies that it's set up as a fund structure, which it's not. What we did actually was we got a little bit more creative and we set these up as Cayman holding companies so we could easily bring in both offshore capital and onshore capital, but also be agnostic to allocators versus other VC funds because it's not set up as a fund, so it doesn't pay any management fees or have like a carry to it. And it operates as an operating company. So what Recharge is meant to do for the next few decades is vertically integrate ecosystems from end to end. And so you can think of these Cayman holding companies as doing a roll-up strategy, but then they can also make control investments into technology that they can layer into their workflow. So there is a future where certain portfolio companies that are being invested in and out of the venture practice could actually get wholly acquired by these platform businesses that we also control. Obviously, there's conflicts of interest to deal with that, but I mean, it's nice to have like that option because one of the biggest issues in venture is liquidity. I mean, these funds are like 10, 12-year funds that, unless you're very astute at being able to access secondary markets, which most people have not been in venture, or you're lucky enough to get an IPO or acquired by a big conglomerate, it's very difficult to manage these portfolios to actually produce DPI for LPs. And so this is another way of potentially embedding the ability to produce DPI for early investors because these businesses are also beneficial. These venture businesses are also beneficial to the platform businesses that we own.
Super interesting. And because the interesting part about this too, and this is a good little plug for Revere who pulled us together. Because they they do their kind of scoring and all of that. The way we were introduced is that you score in the top decile or whatever within their structure on the sourcing side, and it's interesting to like because it pulls me back into the whole thing that you just described. So when you're thinking about sourcing, because you're not a venture studio, like you're not built like, but it sounds like it's almost like thesis-driven investing, but taken like way further, right? Where the thesis leads to a core workflow, and so can talk me through a little bit of like, the end product is you making an investment into a company that's going to service one of the Cayman holdcos that is focused on a specific thing. Give me like a sense of the order of operations that brings you to a venture investment.
Yeah, totally. I mean, look at a place like Tusk Ventures, for instance, or even some of the bigger funds. I mean, there's always that common chart that you see that's like an upside down pyramid or funnel that basically says, look, I'm a fintech investor. Here's the 10,000 fintechs that are building. Yeah. I apply a set of criteria and narrow it down to like 50. I have my analysts write 50 memos, and then we make an investment on 2 of them over the course of the year. There's merit to investing that way. I'm not saying there isn't, but I think we've been lucky to get to where we are to have the support that we have of the anchor assets we've built out. And when you have successful founders in your network, that is ultimately the biggest gravitational pull for talent coming in your door. The biggest risk you run, honestly, is somebody like, Zach at Plaid goes and raises his own fund. I mean, I think Plaid is an outstanding company. I think Plaid in and of itself is building out a platform business that is exactly the type of business we want to try and build out because there's so many tentacles to it. And I think having a venture strategy there makes a lot of sense for what he's trying to do. And so, most founders, I don't think go off to go start their own venture strategies, but the founders that, we've supported through our anchor assets, whether it's, Valon or Bota or RIA with each of those businesses are very connected to our Recharge ecosystem and buy into what we're trying to do. And so when I'm looking at a fintech, a lot of times it's either coming directly from my network or directly from the CEO's network that runs that anchor asset because he or she also knows intricately their issues. So you can almost think of it as like a reverse corporate venture model in a way, because we're financial minded investors. We're not driven necessarily by having to invest strategically for a particular corporate, but a lot of our sourcing can come from knowing the inner issues within these particular businesses and how to solve them. And so you are trying to get the best of both worlds. And corporate VCs are obviously littered with a graveyard of business units that didn't work out for a number of different reasons. And I worked within that realm, and there was a ton of pros and cons to it. But I do think that distribution is very key. So in order to source properly, I think you have to have very good founders, successful founders in your network that understand the key issues of where they're building, because they're the ones that are going to have both the trust with founders that are also building tangential to them. And so if you capture that network, that's what creates the flywheel. And so, that's sort of like the one approach. The other approach is having my team basically put together these core workflow maps in tandem with the CEOs and try to be proactive in identifying those areas. But that is, that's ultimately how we source. I think, to us, it's still a very big net, and it's more than enough to work with. And we consider ourselves having a higher hit rate because I'm only doing maybe 2 or 3 investments per year as opposed to 10 to 20. And that's the entire point, is to be able to produce kind of like concentrated fund vehicles that on average get better returns than your more diversified fund holdings, which if we execute properly, that in theory they should do that. But we don't put the upside down pyramid in any of our marketing materials, because we're purposely not looking at 10,000 companies a year, because we already know off the bat we can kind of siphon off that top layer because we know those aren't the areas that we're going to be looking anyways.
How do you find yourself splitting your time within, because it sounds like within the different assets and those anchor assets and those and I want to make sure I'm using that term correctly. The anchor assets is referring to that more kind of roll-up-y strategy where you're operating, and these are like profitable, like finance more traditionally businesses. Am I understanding that correctly? Like those platforms.
They're either unicorn companies out of our venture portfolio. Or their businesses.
It's not always like you own. It's not always like you own it. There are examples. Yeah.
Yeah. Some of them we majority own. Some of them we've been with since incubation and have very close relationships with the founding team and an intimate understanding of what they're looking for.
Got it. And they're supportive of this model and are pulled into this because ultimately they get custom built solutions to their problems. So why wouldn't you?
Well, they do, but here's the thing. So the ones that have not, the kind of natural movement is from like portfolio company into an anchor asset and eventually to a business platform entity. So even the ones that we might achieve distribution through anchor assets right now that we have minority ownership in, we're still working in tandem with them on a joint venture to create that business platform. So we just haven't done that yet. And the reason why that's important is because a lot of times these anchor assets want to remain purely tech companies. They want to be a software layer. They want to get the highest multiple they possibly can on exit. They don't want to bring in some of these ancillary type of businesses that might complete their value chain because they don't want that to be part of their direct business model. And so within like fertility, it's a perfect example of like, if I'm a brick and mortar owning clinic chains, the EBITDA revenue multiples that you get on that are very different than what you get from a pure software business. So we are helping these software companies within our portfolio basically get that vertical integration within their particular industry, but they're not having to do it themselves. They can do it through our ecosystem. So in a lot of ways, these companies will have ownership in the business platform too.
Got it. Yeah, super interesting. And so so explain, from you splitting your time and like, day in the life besides the extreme sports, the snowboarding accident, which I needed to. But besides that, give me a day in the life for you as you work across what sounds like a very like kind of a. I definitely see how it all fits together, but it's a lot more sprawling than I had a call earlier today with a VC who's it's more traditional seed. Right, where you're looking for undiscovered seed stage companies and you're investing in them. This is not that, right? So, obviously, technically, I guess maybe it is, but give me a sense of your like how you spread out your time, how you think about your priorities on a day-to-day, week-to-week, month-to-month basis.
Yeah, sure. I think my day is probably somewhat similar to other VCs, but with the exception. Not to use the cliche term like taking a hands-on approach, but the fact is like it takes a lot of time to put together each of these deals within our own ecosystem to set up the partnership and really understand how the launch is going to work. And so at any given time, I'll be working probably on like one deal, two deals max. And that will really entail, working directly with that management team and my partner to figure out what that partnership is going to look like with the anchor asset and also helping them construct the financing like any VC would do. But Lauren and I have always like found a lot of value, and especially when you're at the pre-seed and seed stage, on having cap tables that have investors with you that have deeper pockets than you do. And I think that's very important because then these companies that you're building are on the radar already, and these people already have skin in the game. And so we've been successful doing that. I'm building out a pretty good co-investor universe, which I know a lot of VCs would claim, and there is a ton of co-investing among all these VCs. But the way that I differentiate is it really does come down to, at the end of the day, like for instance, Chaos Ventures did 150 deals, so I could put on a slide deck, probably 500 VCs that we've invested with. But it's not the same thing of when we're leading or co-leading or whatever you want to call it, but we're helping to create this company and put together a financing with like one or two VCs that trust us a lot, want to do business with us, and we're probably going to do repeat business with them. And it's one of the big learning lessons I've learned on definitely going from syndication platform to like full fund is there's a reason why you see the same funds working together over time. It's because like these particular GPs develop trust with each other, and it's just so much easier to cut through the politics of putting together these financings, as well as what happens later on as the company grows or runs into problems and has board issues and voting issues. If you trust the people that you've been financing the company with, it makes a huge difference later on.
No, it's okay. No, it's interesting. It makes a ton of sense. Where the trust aspect of bringing deals together and how much that like repeat business, having done deals in the past, can cut through and actually get things done a lot faster. And so for you though, and in these, so are these VCs that you work with regularly, or is it more? Because it sounds like, is it more flexible? Like family office capital? What's the capital stack of that sort of co-invest? Is it VC? Is it just always just VC?
No, it's a combination of VCs and families. That's part of the beauty of like having the Cayman holdcos is they're agnostic to the type of capital providers. So there's certain VCs that do bring, a great network or some sort of edge that we think would be super helpful to what's being built. And so they can invest directly out of their funds because they're investing into an operating company. And then the same thing can be said for a lot of these family offices, specifically ones that do like to do direct investments and have also a hands-on approach. This structure makes it so that they can do that and be very influential on kind of what's going on at these businesses. And so I would say the cap stack is primarily made up of those two particular entities. But then to go back to your question on just how I spend my day, I would say like any other VC, a third of it is probably spent on, relationships with our investors, both on the VC side and on the family office side, because those are, also kind of like clients of what we're building in a way. Spending time with our founders, especially the founders of the companies that have become larger that we're building with. That's another probably at least 20% of every single week. And then we've got a team here that, is very spread all over the place. We've got, partner in Taiwan, partner in Singapore, two partners over here in the States, as well as junior people that are spread across both Asia and the US. And so team coordination and making sure we are doing meetings to keep each other updated on things is really, really important. Coming from larger corporates like a Jefferies and stuff, I've always been kind of anti having too many meetings on your calendar. But we've kind of gone the opposite direction. Sometimes we don't have enough. And so you can, go weeks and kind of lose touch with somebody. And we try we don't want that to happen because we are, one firm working together. Other than that, we this is my CPA coming through, but I built out our whole tech stack. And so that was, I always have fun going in and figuring out new tools on how to add efficiencies to our process, like streamlining the CRM better. Eventually we'll pass that stuff off to somebody else, but I enjoyed doing it. And I think we got a well-oiled machine for where we are as a firm. And then just the underwriting. We do a lot of underwriting around as we do these workflow mappings to figure out where to spend time next. And so we will put together probably a few memos or memo-ish type of stuff. every month to figure out what we're going to be working on next. And some of this can be memos directly related to a company that, we think actually be quite interesting to fit into, one of our verticals. Or it can be kind of doing more thematic work on something that we have not touched yet. That there's a lot of research that goes into that. But I wouldn't say we have not been as good as other firms of putting out lots of content. I mean, I think content's great. It's also a lot of fun to do these podcasts and stuff. And believe me, I've got a ton of stories that I wish I could get on Medium and, spend 6 hours writing about. But when you're building stuff from scratch like we are, we don't like have a huge platform yet. To be able to do that, we have to pick our battles and spend time kind of on the core functions.
So within the theme of sourcing that we had originally kind of gotten connected about, the thing that seems to be really unique about it, right, is that you're not, and maybe you can correct me, but because of this, kind of platform based and building businesses that are going to tap into that distribution, that you're looking for solutions to very specific problems, or you're working with you're working off of a theme. So you're either working with a business that has a very specific problem and you're looking to source to solve that specific problem and invest in that solution, or build or start from scratch, or you're discovering new themes or new areas that you're going to go kind of working in. None of that sounds like really like fighting for deals, right? Like none of that sounds like your kind of classic, like which I think is probably why, which is probably a good place to be. Like anytime I find myself fighting for deals, I feel a little bit like, I feel like I'm in the wrong place. I feel I'm in the wrong spot, and there's other people around this. So do you find yourself being like, because of that kind of differentiated sourcing model, where you're either working off a specific problem solution based off of a distribution kind of channel, or you're working off a specific theme, and then finding your way to understand like the world to work in? Do you what does that like actual outreach process kind of look like? Are you mentioned before, you're being referred in by founders, or are you doing some outbound as well?
I mean, I would say 90% of it is we're being referred in by other founders or just people within our network. I also do think, I mean, look, yes, like there is something to be said. Like you and I both have been in some of these like super like crazy rounds where everybody seems to want in and everybody's getting cut back, and Tiger and whoever is saying they want to just take down the whole round. I personally think like venture is going a different direction. I think you want to play nice in the sandbox. If you are the guy coming in and taking down all these rounds now, it does get harder and harder to do business with you over time. Now the politics of like who actually gets one on the cap table, that always is kind of a question mark no matter what. But I think because of the very clear kind of like objective value that's added to these founders, we definitely have not really been in a position where somebody has like walked down the aisle with us and then decided to go with another firm just because the value proposition is just so tangible that we can provide this channel to really help them iterate on product and frankly provide non-dilutive financing through revenues that they otherwise might not get. And the playbook, I kind of got some of this from like working with Bradley years ago, because like we would provide kind of these bespoke regulatory solutions for companies that in and of themselves like didn't sound like much, but what a lot of people didn't realize is like some of the things that were being provided were being provided to accelerate a timeline that might have been 12 months down to 3 months. Like Lemonade is a great example. Like, Lemonade wasn't creating something completely new in terms of becoming an insurance carrier and getting licensed to do insurance. But because they were a tech company and because they didn't have a ton of money to blow on legal fees, they needed a quick way to get into New York, Texas, and California, because those are the biggest markets to sell into. And so we were to help them do that a lot quicker, which gave them a massive head start on every other managing general agent and carrier trying to come into the market to do tech-enabled insurance underwriting and binding. It just wasn't being done during that time. So, what I realized like at Recharge is like it's not so much that like this customer that we're providing has to be the biggest customer of all time and it's going to make or break their business. But what it's giving is a really amazing case study, initial revenue, and working around product iteration so that we're not sitting here trying to customize this solution so that it's no longer scalable to other clients. So I guess that's a roundabout way of saying, like, we do play nice in the sandbox with other VCs because I want other people to be involved because we're not sitting here investing at the Series B, Series C, and Series D stages. That's not where we're playing. But two, I mean, I think the value add here is so tangible that if it is the right founder, they're going to want to work with us. If it's not the right founder because they're trying to optimize for something else, whatever that might be, then it's probably not the right business for us to fit into our puzzle anyways. Because what happens when we fit them in is there also is a tangible benefit to our platform business or anchor asset at the same time, and that's important as well.
And so in that situation, when you're in that flow of a founder, who is, you're very aware of their workflow. They're obviously very aware of their workflow because they work in that work. That's what they do all day. And they identify this problem, and then, they introduce a founder who's maybe solving that problem for them, or they think they could solve the problem for them. Is that a financing because it's not, do you cut out do they happen to be fundraising part of it? Like, are you find yourself like starting a process? Are you getting introduced to a founder that you then are deciding, like, does this go along with their other financing schedule? Is it just totally brand new? Like, how does that play out from a timing perspective?
Well, I mean, we definitely prefer it to be brand new. I mean,
yeah,
the easiest is you come in and, a company, maybe they've been, fundraising a little bit and they have some angels, but we can kind of like control the pricing as well as like the structuring of it, which is important. There's a lot of things that are important outside of just the valuation. And then we can help construct the cap table around that because I can bring in people that I've worked with before that I trust and I know that they believe in this vision and they're going to be value add in some way, either now or down the road. But it doesn't preclude us from participating in a financing where the cap table's really been put together already and maybe they're trying to fill a $500,000 hole and they really like our business. I think it would have to be a higher threshold to me to do one of those deals because it would have to just make total sense and we'd have to obviously be working in tandem with one of our anchor assets to set up that.
It'd have to happen. Like, that could happen, but that seems really unlikely that would, like, they happen to be looking for $500K and it happens to fit in. Like, it happens to be the right puzzle piece. It seems like more like you look at the puzzle, you see the empty slot, you go find the piece that's going to fit rather than whatever.
Totally. Yeah, I'm not saying it has. I mean, to be honest, that hasn't really happened yet, where there's like fitting that puzzle piece. But I'm not saying we're really incubating either, because it's not set up as like a normal studio model. Yeah, nothing against studio models. It's just that we're not sitting here with like 200 ideas and narrowing it down to like 2 that we're going to execute on. That's not how we're set up.
Yeah, no, super interesting. And then in the just to get in the weeds of those deals really more specifically, because would these be seeds? Like, are these seed deals and then you're like, is it typically a seed company, or is it like, and you're de-risking them to Series A by giving them like that case study that, like, that because of the distribution, basically, that I'm going to give you this seed money, you're going to plug into this these people that we work with, and you're going to be a Series A company, and then but they continue on hopefully to like.
I mean, it's simple. I mean, it's a function of like how much time there is in the day and the year, and also like a deployment schedule of about 4 years. I mean, it's pretty easy numbers to run. I mean, if you're aiming for like a particular percentage of ownership, it would have to be seed stage, and somewhere between like $7, $8 to $20 million valuations, and obviously aiming for that 10 to 15% ownership stake in these companies. And that's the time that we would want to get in, because to make this model work, we do need like relatively high ownership percentages, because we're only doing about a dozen deals in the whole fund. And so, obviously getting the pro rata allocations for the later rounds is super important, at least for the next round, because so that we can hold to that percentage, or at least not have it get diluted too much. Because the expectation is that not one of these is going to be an outlier, that anywhere from a third to a half could be potential outliers, not necessarily 1,000x returns, but we're aiming to create net 5x returns on a net basis, because that would put this type of model not just in a top quartile bucket, but something that's scalable. Like, that's the idea, is like building out like a scalable venture franchise. Because when I look at some venture franchises, especially some of the newer ones, a lot of the sales pitches are around, I worked at a particular startup or founded the company, and I have a very very distinct type of network and skill set. The problem is like that strategy, it can definitely work for a few funds, but it's not something that's scalable into the future. And so like what we're trying to build here at Recharge is something that like can scale like outside of me. Like, I don't have to be here, and neither does Lauren. And so the value just compounds over time, because as the anchor assets get created and they get bigger, like for instance, as Valon goes from 100 to 200 to 300,000 to 1 million homeowners, that creates a bigger net to continue to build fintech companies on top of that. And then and then as another anchor asset gets built in a different type of vertical, whether it's like, pet care or blockchain or whatever, that only continues to compound in value over time. And so it actually becomes like a scalable venture franchise that builds on itself. And every new venture fund can create companies that benefit from all the underlying existing anchor assets from the past. So that's kind of how we see, we're really trying to like productize venture in a different way.
Yeah, no, super cool. And one of the, and we're coming up on time, but I'm interested how whenever I hear about new models that are exciting to me, and I have a good friend who runs a super cool, and I'll plug him because I think it's really great, but it's called the Canon Project, and it reminds me a little bit where he has this, he does sales placement is his core business, and it's a guy named Ian Feeney, and then he'll place salespeople, like really high performing salespeople, into these companies that are like at this inflection point where they need salespeople, and they're going to go from like 500K to $1.5 million in revenue, and he'll get allocation and get, like, because he's so good at it, that's how he systematically sources, like systematically gets access to rounds that you wouldn't normally be able to do, and he really is an information advantage. Because he does sales, right? Like, so who knows the numbers? The guy who runs the sales, or who built the sales team out. And it reminds me so much of this, where there's this like kind of really systematic. It's not I know guys, or I know people in the space, right? But the funny part about that experience, and I'm interested about yours, is it's not typical, and therefore it requires some relearning on the LP side, right? So like, what was that? From a fundraising perspective, like when you present new things, same as any business, right? The new part of it is usually, like, even if it's great, a harder pitch, right? So what was it? A longer, like, was it just an education cycle? Was it like, what was the, like, because you can't really fit, it's venture, but I don't know. Like, it's definitely technically venture, but after this whole conversation, it doesn't seem right to call it just like, oh yeah, it's a seed fund. Right, like,
no, totally. I mean, look, it of course doesn't bucket perfectly into where the endowments play, or where any of the fund of funds play, and it's but that's part of the sales process and re-education in the space. I mean, we've got a good set of investors. I was able to bring in about 68 of them from Chaos to get it all started. We've got a few institutions in there that both invested in the fund as well as the Cayman companies. But like anything else, I mean, it doesn't really matter who you are, I guess. There's always going to be people that don't necessarily see the vision the same way you do, or they do see it, but it just doesn't fit into their framework for how they allocate. And that's okay. Yeah. So what we're looking for is kind of the allocators that are thinking at the edge on going, maybe there is merit to not just investing by asset class, or investing by geography, or investing by stage. Maybe trying to vertically integrate ecosystems within the asset manager itself is really cool. And like, I actually appreciate when I show somebody the venture fund, for instance, in a marketing thing, and they say that they're interested in venture, but what they're actually interested in is the holistic platform, like, which we're not selling right now. Maybe in the future we might capitalize that in a certain way, but the platform has ownership in the venture management company, the management company for a couple hedge funds we actually have, as well as the ownership in the platform businesses that we've started. And so, the idea over time is that all these businesses work together. And so this is truly like an asset manager where your goal is to vertically integrate these niche ecosystems. So Yeah, I mean, look, I'd be lying if I said that there aren't some sales processes where it kind of goes over people's head. But then not every investor is meant to be a match, just like dating. So
Yeah. No, absolutely. That's super cool. Super cool. I really appreciate you jumping on and educating me on it. I definitely feel a bit smarter, and I think that there's maybe it's a conversation for another time, but venture is changing a lot. Changing a lot, and I'm super interested to see how it all plays out, because I don't think it'll look the same as it does, right? I think that there's a lot of conversation about that happening. So, well, awesome. I'm gonna press. Thank you for listening to the Sandhill Markets podcast. If you enjoyed this discussion, make sure to click the link in the description to subscribe to our newsletter. You'll be kept up to date on venture news and our weekly live events where we host similar discussions with other amazing guests. You can also follow us on LinkedIn and Twitter, where we post regularly about upcoming events. Once again, thank you for listening, and talk soon.